Way out west, if you have an IUL and you get to the tipping point of it eating itself alive, what's the best way to exit or transfer the funds? Tipping point 60 to 75 years old. So 60 years old, it should not be the tipping point. An IUL, the cost of insurance does not start to really go up until you get into your 70s. Ideally, if you make it to 75, you've got the overloan protection rider. You can pull out all the cash, 95% of the cash value, and just turn off the policy essentially without having the tax consequences. If the policy is going to be eating itself, you waited too long to take action. But the only reason it would eat itself is if you're not funding it at a high enough level. And if you're not funding it at a high enough level, you can reduce the death benefit and bring that MEC limit down and the costs within the policy. So there's no reason to keep paying for more than you can afford. And if you're not max funding those policies, I don't even recommend using them. And you don't want to minimum fund a policy and run the risk of it lapsing because you underfunded it. And if you're max funding it, it's not going to lapse. It's not going to lapse. You're putting in way more. If it's max funded how I design it, I should clarify. You're putting in way more than the underlying cost of insurance is gonna run you. It'll last a long time, even with hardly any growth in the policy. It'll last a long time. Would I consider life insurance as another hedge against inflation? Absolutely. Absolutely. That's why it's better. It's a better place to store your emergency funds, capital expenses, as opposed to keeping it in a savings account or checking account. Those are not a hedge at all against inflation. In fact, they don't give you hardly any growth. And if inflation is happening, you're just losing value. Your dollars are losing value. You get into a whole life policy that has a 4% guarantee, although that's changing soon. Even after the expenses, you're likely going to beat inflation, even with the guaranteed rates. So pretty interesting. Yeah, I would definitely consider life insurance as a hedge against inflation. The other thing too, not only is keeping your money in it a hedge against inflation, but let's say you encounter runaway inflation, hyperinflation. You could pull your money out of your policy and just go buy an asset. Let that asset grow with the hyperinflation, sell it, pay off your loan, and still have money left over. So it's a good way to actually fight hyperinflation as well. Do I think we're heading into a heavy inflation or already in one? I don't think we are. I don't think we are. We had basically negative inflation last year, and it's catching up this year. So it looks like heavy inflation this year, but when you take the average over the last 2 years, it's about normal, I think. I think that's what it's looking like. So we'll see what happens. It might end up increasing, and we might see more, but that would most likely only happen if all of the efforts to stimulate the economy, to help people that are hurting, if all of those efforts just go to people who don't need it. If all those efforts puts more money into the hands of the people that already have money, it's going to lead to more inflation, heavier inflation. If we get it into the hands of the people who need it, who are struggling, going without work, I don't think we have to worry about the inflation in that case. Not heavy inflation.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.